Okay, so in this video, I am going to talk a little bit about some basics of ratio analysis. So when you're looking at a ratio analysis, basically ratios involve relating a couple or more numbers to each other. So for instance, if I look at net income over sales, so I'm looking at net income relative to sales and I'm getting a proportion or a ratio there. And so if I do that, then I could compare two businesses, one that has $1 million of net income, the one has $10 million of net income. If one business is 10 times as large as the other, I could compare on the basis of that proportion and get perhaps a little bit more of an even comparison in terms of a proportionate result. So this enables comparisons between firms on a little bit more of an even footing, kind of setting aside some of those size issues and things like that, and making it a little bit more focused on the actual proportions of results that companies are achieving. And that can provide some context when making decisions. Looking at say, how's profitability changed over time? How well is the company doing at collecting receivables? Do they have too much debt? It gets some broader context and better things you can analyze and assess. And ultimately, that feeds then into managerial decision making. So it provides information that managers could use to make decisions, and hopefully, better quality decisions. They can try to find and spot problems that are developing before they've gotten out of hand. They could try to then course correct for the firm and make different choices to try to address them. If the firm has too much debt, they can try to make choices to limit how much debt they're going to have going forward. If they have too little liquidity, they have not enough cash on hand, things like that, they can try to correct that before they run into a big problem and run out of cash. So basically, it provides some guidance for managerial decision making. It can also put some parameters around what's possible for a company. So if a company is already utilizing their assets extremely efficiently, and that's visible through ratio analysis, then you might look at that and conclude, well, if they're going to expand, they're going to have to buy more assets. They just can't produce more with the assets they have. So it can really provide some help for decision making as well. On the other hand, it can also be helpful for investment analysis. So if you are interested in buying stock in a company, for instance, we can examine a company's ratios and try to see, does it look like they're about to go bankrupt? Have they been making progressively more profit relative to their sales or relative to their assets? Are they becoming more profitable as a company, or is it becoming less profitable as companies? Does it look like they have some problems that are going to create issues for them down the road? And so forth. So all of that can inform some of the investment choices that are made in terms of, does this look like it might be a good company to actually invest in? Now, there are a few different types of ratio analyses. So cross-sectional analysis is basically analysis comparing one company to other companies, generally in the industry. So that's cross-sectional. So if I look at one company relative to another company in the same industry, that's cross-sectional. Time series analysis or ratio trend analysis is if I look at, say, a company's ratios at multiple points in time, and I'm looking at how that has evolved over time, then in that case, that's a time series analysis. Now, a fair part of the time, you're probably going to wind up doing a combined analysis, which is a cross-sectional time series or ratio trend analysis. So here's what that would look like. If I take the ratios of my company over several years, and then I also look at my main competitors over several years, now I have a cross-sectional because I have my company and my competitor, but I also have a trend because I have over multiple years. So that would be a cross-sectional trend analysis. And that would therefore be a combined analysis. Now, there is another type of analysis, which is intra-company analysis. This would be analysis of perhaps different divisions or segments within a company. And if you are working for a company and have access to that kind of level of information, that would be very interesting and important to look at when making decisions about where your money as a company should be allocated. It should be allocated to this division or to that division, and why. And we should look at that. However, unless you have access to that level of information, you can't really calculate those ratios for the most part. And generally speaking, companies are required to make mandatory filings, so 10K filings and 10Q filings in the United States. And so for those quarterly and annual reports, generally, you're not going to find a full set of financial information broken down by segment or subdivision within the company. And so oftentimes it's pretty limited what you're able to look at in terms of intra-company analysis if you're on the outside looking in. Unless you were working for the company, you probably don't have enough information to do too much with intra-company analysis. But we can still do cross-sectional and time series analysis. But that brings up the idea of benchmarking. So when I'm comparing my firm to some other firm or competitor, the idea is we're basically benchmarking. We're using a reference point to kind of assess how well we're doing. So another thing that I could do is I could look at an industry average, for instance. So I could look at multiple companies in my industry, calculate the same ratio for all those companies, and do maybe an average or a median or something like that for all of the results for all those companies in the industry. And then I could compare my ratio to that and see how well am I doing relative to other companies in the industry broadly. Now, something to think about when you're looking at benchmarking is who exactly am I comparing to and what is my standard? So here's what I mean by that. If you look at Apple, for instance, it's 2025, and when I'm making this video here, and if you look at Apple, well, they've got cell phones, they've got computers, they've got iTunes, right? So if you think about cell phones, their chief competitors for cell phones would include at this point companies like Samsung, Google, and a whole slew of various other ones, right? If I think about computers, well, let's see. We've got Surface Products, we've got Lenovo, we've got Dell. We got a whole variety of other providers that are creating computers, right? If I start looking at iTunes and the fact that you can purchase various forms of media through that, well, it's competing with all kinds of companies, whether that's Spotify, Amazon, Prime, all kinds of companies, right? Or Amazon Music, and I mean, just the list kind of goes on. So one of the things that gets kind of tricky is if you're trying to compare companies for the sake of benchmarking, if I just focus on the industry that the company is in, the reality is a lot of these companies are actually in more than one industry. And so if you're kind of too blindered and focused on, oh, this is their industry, then you can kind of miss out on the fact that really, some of their main competitors could be spread across several different industries. And maybe I ought to be comparing to companies from multiple different industries because those are actually my relevant competition. So when you're benchmarking, you really kind of have to ask yourself, what am I trying to learn from the comparison? And therefore, what should I be comparing to? And that kind of informs your choices a bit. And so it may make sense to actually compare your firm to companies in multiple different industries because those are the ones you actually care about. Also, to use another example, if I'm looking at Walmart and I am comparing them to like all of retail, well, I don't know, that's the best comparison, right? I mean, if I'm starting looking at some of these, mom and pop little small stores, I mean, the ratios could look very, very different for them compared to like a Walmart. What probably would make more sense would be to compare Walmart to companies like Target or various other competitors as well. So potentially grocery stores, potentially electronic stores, maybe to some extent Amazon even. So from that standpoint, you really kind of have to think about what am I trying to learn from comparing the ratios to make sure that you're selecting an appropriate benchmark. That also means that you need to be thoughtful about exactly what you're comparing to in another way. So if I look at, and let's say a company is just nice and neatly in one industry, so I don't have all kinds of cross-industry issues or anything like that. But even if they're in one industry, if I calculate or find the industry ratios for the industry across all the companies in the industry, one of the problems you might run into here is if I'm using the average in the industry, so if I'm comparing my ratio to the average, basically I'm just saying, so maybe I'm better than average, but like really, like that's my comparison, like, hey, better than average. Like I don't know that that's really what we're going for. We're really trying to do a great job here. So which will, basically what that means is you need to be kind of thinking about, what am I comparing to? What does that tell me? Maybe we shouldn't go too crazy with getting excited that I'm, doing better than the average when, well, that just means I'm, I think I'm better than average, but that doesn't say a whole lot, right? So from that perspective, maybe you start looking at maybe the top 10 best companies in the industry. Or again, maybe it circles back to, maybe I look at the top several companies that I'm actually really considered to be my competitors. Maybe that's what I look at. So you need to be careful about what you're looking at when you start doing comparisons and make sure you're making appropriate choices for that. Okay, so there are also some challenges that you can run into as it relates to evaluating ratios. Let's talk about that a little bit more. So first off, generalizations are really problematic. So trying to figure out what makes like the best ratio or something like that is really kind of a problem. So let me give you an example. If I'm looking at General Mills, well, they basically, they sell things like cereal, right? So if you think about that for a moment, how stable is the demand for cereal? Probably pretty stable. And even in a recession, people are probably still going to buy cereal. Probably not going to experience a really huge decline in sales, even in a bad economic environment, because they're selling cereal, right? So it's probably not going to be, that badly affected by a recessionary environment. So what that means then is they probably can tolerate having less cash on hand. They could probably get away with having more debt, things like that. On the other hand, if I was looking at an automobile manufacturer, well, you know what people don't buy a lot of when you go through a recession? Cars. They tend to not buy a whole lot of cars in a recession. So if that's the case, probably we're a lot more economically sensitive if we're a car manufacturer. And if I'm a car manufacturer, a lot more economically sensitive, probably what that means is, I probably ought to have more cash on hand. I ought to have probably less debt, and things like that. And so here's kind of the point for that. Basically, that means that I really kind of have to look at the entire picture. So what kind of company this is, what kind of stability of sales they have, what's going on from an economic standpoint, and so forth, in order to try to determine what makes sense as an ideal ratio. What should the ratio look like? So basically, you got to use your brain, okay? Because there is no perfect ratio. And here's kind of why I'm cautioning against that. If you go online and you search for what's the ideal current ratio or something like that, you're going to get some nonsense that says something like the ideal current ratio is 2 or something stupid. And the reason why I say that's nonsense is because a current ratio of 2 for a company like, say, General Mills might be much higher than needed. They may not need anywhere near that much cash on hand or short-term assets. On the other hand, if I'm looking at a company that is more of a startup with really shaky prospects, very unstable sales, a current ratio of 2 may be wildly low. They really may need more flexibility than that would suggest. Or similarly with debt levels, right? What might make sense for one company could be a terrible idea for another company. So importantly, there isn't like a perfect ratio. You have to look at the whole picture. What kind of company is it? How stable are the sales? What kind of market is it in? What are the industry trends? What's going on in the economy? What's happened in prior recessions for this company? And try to, piece that together to figure out, okay, here's what looks good as an ideal ratio. Here is what would look bad, and then analyze from there. So you really have to think about it. So it's a little bit of a challenge. But it's actually kind of fun too, trying to tease that out and figure out, well, what really makes sense for a particular company. Even within the same industry, what's ideal could be different. We could have one company in the industry that's going a mass market approach. They sell to everybody on a low cost leadership kind of basis. They're just selling at the lowest cost, mass producing kind of their product kind of a scenario. The kind of ratios they're going to have are going to look different from a company that is in the same industry, but is producing more of a high-end specialized niche product. And as a result, they can have very different ratios because they've made very different business decisions and they're following very different business models with very different business target markets. So random shout out to marketing folks out there. That matters for what kind of approach you're taking from a marketing standpoint, where your target market is affects the ratios. So we have to be thoughtful about that as well. Now, a few other things that are worth noting. Changing accounting standards can create problems. So if a firm changes accounting standards, or if accounting standards are changed by regulatory authorities, things like that, it can make it difficult to compare ratios over time. So that can be a kind of a problem. So you have to be aware of that. If they change what form of depreciation they're using or something like that, then that could shift the ratios, basically not due to a change in the underlying business, but just due to how they're handling the accounting. Also, inflation can distort results. Let me give you an example for this. What if I had two companies that are in the same industry? They have basically the same manufacturing capacity, but one of them started up 20 years ago and the other one started up yesterday. Well, The one that started up 20 years ago, when they bought their facility, the cost of the property, plant, and equipment was probably a whole lot lower. And so when it's recorded on the balance sheet at historical cost, it's going to show a much lower value for that property, plant, and equipment. Now, they probably upgraded and everything else over time as well. But the land is probably still capturing, the building is probably still capturing, at least largely, what prices look like 20 years ago. Whereas the company that started up yesterday, those are reflected on the balance sheet based on what real estate looked like yesterday. So you could have a situation where realistically they have the same type of capacity. They might even have facilities that are worth the same amount, but on the balance sheet, it looks like the newer company actually has more valuable assets. But that means that it also looks like it's taking the newer company more assets to produce the same sales. So you have to be kind of careful about the fact that inflation can distort some of those results. You have to be a little bit mindful about that. Also, different accounting choices could distort interpretations. So think back to accounting, and you had FIFO and LIFO. So FIFO, first in, first out. LIFO, last in, first out. So under first in, first out, the inventory that's still on your balance sheet is the newest inventory. Under LIFO, the inventory that's still on your balance sheet is the oldest inventory. And back to inflation, if there's been a lot of inflation going on, I could have two companies with the same number of units of inventory. If one's doing FIFO, one's doing LIFO, they're going to show up on the balance sheet at very different dollar values. And so that could kind of distort how you compare those and what it looks like, who it looks like is more efficient based on those accounting standards. So that's something to kind of just be thoughtful about. If you're aware there are different accounting standards, just be careful that you don't push your conclusions too far. There could be some things that affect them. Now, some people go all the way to the point where they're like, you just got to throw all the ratios out, nothing can be compared. There are all these issues. I think that's way too far. And generally, for the most part, a good chunk of the time, I don't think people need to go too crazy with trying to correct for every last possible issue. But that is kind of a general note that these issues do exist, and sometimes they could be big enough to materially affect your conclusions. So kind of bear it in mind and start looking for things like, hey, I'm comparing two companies. Is there any indication in their notes to the financial statements or anything like that? What kind of inventory accounting they're using, and just see if you can see. And if there's something that is cause for concern there, all right, well, maybe I should kind of think that through a little bit and maybe evaluate what that would imply for my conclusions here before I get a little bit too focused on what numbers I'm looking at the moment. Also, there can be some seasonality. So some businesses have very seasonal businesses. So, think construction, renovation, things like that. They tend to do a whole lot more business, probably more spring, summer, fall, not as much in winter, right? So summer is probably like a big season for that for the most part. So as a result, if I'm looking at quarterly results, probably they're going to have much better results in the summer. And that's just kind of normal for that kind of business. So you have to be kind of aware that some businesses are just by nature going to have certain quarters that just are much, much better. And so if you're not careful and you just start looking at a company like, wow, this quarter was so much better than last quarter. Well, maybe that's just a seasonality effect. Let's go back a couple of years and let's look at kind of how quarter by quarter how things have shaped up. And maybe this is just normal for this particular quarter of the year for this company. So you have to be kind of careful with that. Also, and this is sort of an easy thing to kind of overlook, but the financial statements do have to be accurate, because if you're calculating ratios based on the financial statements, the statements have to actually be accurate. And if the statements are not accurate, if they had errors, or worse, if they had some kind of fraud or things like that on there, where companies basically lied about the results, misrepresented their results, well, then you can calculate all these ratios and do all these analyses, and it's not really going to capture what's going on because of the fact that the numbers that you're basing these ratios on are incorrect, right? So it's easy to kind of forget the fact that the numbers do have to be right that you're working with. So just kind of bear that in mind. All right, hopefully this kind of gives you a little bit of a brief overview about some aspects of ratio analysis, things to kind of consider, and benchmarking and types of analyses and things like that. And hopefully kind of sets the stage for some of the future videos that I'm going to be doing about different types of ratios and kind of how to think about some of those. All right, thank you so much for watching, and have a great day.